The US equity market has been very much driven by monetary easing expectation, and we will probably see the cuts to be executed next week. So this is a positive element. But now we have to wonder how long a lower interest rate can support the equity market, and for having some sustained equity market rally, we need to have the earnings to grow. And this is something on which we have our doubt for the next 12 months. So that's why we are not saying that we are getting out of the equity market, but we want to diversify. And among the risky assets, we find commodities to be an interesting asset to hold.
Right. Frank, it's an important day in the United Kingdom as the Conservative Party decides on its next leader and, of course, the future Prime Minister of the country. You're saying a weak GBP is not all bad for UK equities. Is that premised in the fact that 50%, largely, if I'm not mistaken, that's the kind of exposure that the benchmark FTSE has, or the companies listed on the FTSE have to overseas revenues and profits, and that's why you think a weaker pound would help?
Yeah, so what we have in our global allocation is we are holding UK equity. Actually, we have even some overweight position, and there are really two reasons for that. And the risk of a no deal is increasing and has increased. It is putting some pressure on the sterling, and this. It means that if we do some investment strategy among the UK equity, it's good for the FTSE 100 versus the more domestic FTSE 250, or we can be a little bit more granular and to look at the company which are going to benefit from this. So all is not negative, and the other thing that we are looking is. Where we stand in terms of the valuation, and you look at the dividend yield gap, the excess of dividend versus the gilt, this gap is one of the highest in the world today among the major equity.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.